You see my screen okay, Cindy?
Yep. Good afternoon, everybody, and welcome to today's credit webinar. Before Jim dives into this, let's introduce Jim. He's a distinguished professional in mortgage banking with an impressive 3-decade a career in lending. We don't say years anymore. We just say, 3 decade, whatever, because we're all getting older. In lending, currently serving at New American Funding, Jim's expertise extends beyond his extensive experience in real estate financing. He is an acclaimed trainer who demystifies the complex world of real estate loans and credit. And may I say, credit is his favorite topic, so you'll really enjoy this. Jim's exceptional training skills equip clients and agents with the knowledge and confidence to navigate the mortgage process smoothly, ensuring they find a mortgage solution perfectly suited to their needs. And he's extremely patient with his clients. I don't think I've ever seen a more patient lender. Jim is highly regarded instructor at Cindy Bishop Worldwide, where both agents and consumers consistently give him top ratings, a testament to his effectiveness and impact. So, with no further ado, let's welcome Jim. Take it away. And with questions, just unmute. There's nothing worse than waiting especially when you have a small class, because the question could be answered while it's being taught versus waiting until, somebody looks at the chat or later. Okay. So just make sure you unmute. You're welcome to do that. All right, Jim, take it away.
Okay, thanks, Cindy. Hey, yeah, and exactly, guys. Unmute yourself and just shout right out because small class, but also too, I have a tendency to kind of roll right through things. So we want to stop me when we get into it. So today, we put this together in order to give you a better understanding of credit, how to control it, and give you an idea of how it impacts your life. And so by doing this, we're hoping that you'll be able to, one, get a better understanding, but use this knowledge to be able to maybe create more business for yourself. I always tell people that it's good to help people that have challenges with credit because they're very loyal, and you'll get a lot of repeat business from somebody like that. So the three major credit reporting agencies that we have is Equifax, Experian, and TransUnion. Now, years ago, it used to be that Equifax was only reported, for creditors on the East Coast. Experian was the West Coast, and TransUnion was the middle of the country. Well, now with the technology and everybody keeping their phones and the internet and everything, so most all creditors will report to all three repositories. And so when you're getting, depending on what type of credit you might be applying for, will determine, but most, I would say, if you're going for, like, say, a car loan or a mortgage loan, certainly they're going to be pulling all three, the repository. So the information, where's it come from that they have in their reports? What they do is they gather the information from the individual creditors. So if you have, like, say, a car loan with, like, say, Toyota Motor Credit, they're reporting that to each of the credit reporting agencies on a monthly basis. And so, and they'll usually report it to all three. Now, it doesn't always happen that way, but generally speaking, they will report it to all three. So if you got a car loan, if you got, credit cards, mainly mortgages, those sort of things will show up on all three of these repositories. And then what happens is when we pull a mortgage credit report, what they'll do is they'll take the information from their databases and they'll put it together in a certain, I guess, format for, and we can change that format, but each individual mortgage company will have their own individual format on that. So so the credit scores, have become so important, and they've been around for years and years. In the mortgage industry, they only really started right around the year 2000, just a little bit before. To just give you a brief history on the credit scores, Fannie Mae and Freddie Mac, well, actually, it was Fair Isaacs. Fair Isaacs approached Fannie Mae and Freddie Mac, and they, right around, I think it was 1999, and they told them that they had a system that they could predict how a person was going to make their payments in the future. And so they didn't really believe it. And so what Fair Isaacs did said, well, if you give us loans that you have purchased over the last 5 years, we'll run our analysis on it and we'll come back and let you know which ones went to foreclosure, which ones had late payments from time to time, and which ones you never had any issues with. Well, they did that, and when they come back with the results were super accurate. It just made everybody kind of stand up and take notice. So if you think about it, so the credit scores, what do they indicate? So they provide the best guide to future risk based solely on a snapshot of your credit report. So the higher the score, the lower the risk. So remember too, it's just a snapshot in time. So the credit scores can be changed over weeks and months, depending on if you know what to do in order to change them. So this means that the credit score is a predictor of the person's likelihood to make future payments, and that provides providers a valuable tool in making their lending decisions. So in the mortgage industry, we'll talk about a number of other industries that credit scores affect, but in the mortgage industry, what happens is that the credit scores, when they first came out with them, they were supposed to be just an underwriting guide. And because of that, the underwriting, the mortgage industry said, nah, we're not really interested in. And then what happened is the Fannie Mae and Freddie Mac came back and said, listen, if you don't use the credit scores on these, then we're basically not going to purchase these loans. So that kind of changed the whole industry moving forward as far as the credit scores are concerned. And also too, because it's a snapshot in time and it's very accurate predictor, it can be changed. It is something that with the knowledge and making some adjustments to your credit profile, you can actually move your credit scores in an upward position, moving from, like, say, 620 to 700. So how is the credit score calculated? So and the credit score here, you have this pie here. So the payment history is 35%. So they're looking at the payment history and how you're making your payments on a monthly basis. So depending on the type of payments, now late payments on a credit card are not going to have as big as an impact that it would be, like, say, a late payment on a mortgage. A late payment on a mortgage are going to take a lot more seriously, and it's going to ding your credit score a lot more. So the second one, amounts owed, this 30%. Now, this is an area that you really can manipulate your credit score. Amounts owed, what they're mainly looking at here is the percentage of outstanding balance, and they're looking at your revolving credit. So mainly credit cards. So they're looking at the outstanding balance compared to the available limits. So the example I always use, say if you had two credit cards, and each credit card you had a $5,000 limit, and on one you had a zero balance, and on the other you had $3,000. What they're doing is there's two calculations that they're using in these formulas. One is they're taking that 3,000 of the total, which is 10,000, and that gives you 30%. And then they're taking the 3,000 of the 5,000, which is 60%. So as that ratio goes above, they say 25%. I've seen it affected as low as 20 and sometimes into the teens. But the idea is to keep that percentage as low as possible, and that'll keep your scores up on that. But so what happens is a lot of times we'll see people that have, like, say, a number of different credit cards, and they say, well, I'm just going to close that. And just by closing that, say if we use that example, just by closing the one I never use it, I'm going to close that one and has a zero balance. Their ratio went from 3,000 of 10,000 to 3,000 of 5,000. So it went from 30% to 60%, and that's going to drop the credit scores down. And that's an area that we look at as lenders in order to improve the credit scores. But just by changing those profiles a little bit, changing the available credit, we can get moving the scores up. The length of credit history they're looking at that. So this is, you're seeing that the percentage of the pie is dropping down. So the percentage, 15%, excuse me, the percentage is 15% for the length of credit history. Now, they're looking at how long you've had your credit, how long it's been established, but they're also looking at if you've opened up new accounts, like, say, in the last year or 2 years. So the longer you've had a credit history, better that's going to be for you. And if, although they're starting to make adjustments now for people with a lot of newer credit, and that's where you get down to the 10% new credit. Mainly what that's looking at is not only new credit, that just opened up, but they're also looking at inquiries. So the inquiries are, you basically have two types of inquiries. One is what's called a hard pull, and the other is called a soft pull. So the hard pull would be, like, say, if somebody is going for a mortgage, they got a ratified contract and they're moving forward, we need the financing. We would put a hard pull, which is all three repositories. A soft pull is just kind of a peek behind the curtain. What happens is most of the time a soft pull is just one repository. And what that does is that gives you an idea of if there's any challenges or issues as far as the credit is concerned. And then you can start working on that. A lot of times we'll pull that if we working with somebody that does, that we know might have challenges with credit, but even if they don't, we want to take a look at that. Now, what our company's actually just recently started doing on the soft pull, instead of just one repository, we're looking at two repositories on the soft pull. Then that way, what we do is we know what the credit score that we're going to use. We know what the lowest one's going to be, because what happens is you get three credit scores. We use the middle of the three. So if you have two, then it's going to be, it's not going to be any lower than the lowest of those two. So that helps us as far as getting an idea of what we're looking at on the person's credit. And also too, it allows us, the soft pull allows us to see if they have any credit issues or challenges that we need to address. And then the types of credit used, they'd like to see a good mix, maybe some store cards, credit cards, mainly credit cards, but also, let's say, a car loan, mortgage loan, that sort of thing. As you don't have to have that to have a high score, because it's only 10%. But if you have a good mix, then that's going to help you as far as getting the scores higher. So on this slide, this is when I'm sure you've had people that are looking for, and this happens with, I think, different agencies, like if somebody's getting a car or different industries. But in the mortgage industries, a lot of times, we're getting ready to pull somebody's credit and they'll say, oh, I know my credit score is at 730. I just had it checked the other day, and they were using it checked like through their bank or their credit card, or now giving, credit scores. What those systems, generally speaking, are using is what's called the Vantage. So the Vantage score is a little bit more flexible. It allows people, there's certain things that they're not counting. And so what it does is, and the users, I guess the pie is split into more pieces. And so the credit scores, generally speaking, are coming in higher than when you're comparing with a FICO score. And we always explain that to people before we actually pull the credit, because they say, hey, my credit score is 730. We pull it, and then, it might come out like 710 or even 690. And we let them know that because the Credit Karma and other industries, or like the credit cards, the banks, they're using, generally speaking, using the Vantage score. So the Vantage score, like I said, is more flexible and usually is scoring people higher as far as their credit scores are concerned. So you can see down at the bottom, they listed several things that are different as far as the Vantage score is concerned compared to the FICO. Now, just recently, it was, I believe in July, FHFA, which is the department that controls or oversights Fannie and Freddie Mac, they basically have said that it's now okay to use the Vantage scoring system. Now, that Vantage score system was developed by a combination of Equifax, Experian, and TransUnion. So they came up with that system, and the mortgage industry, although it hasn't moved to it yet, usually pretty slow moving in that direction, but they've gotten the okay to move in that direction. So you'll start seeing that Vantage score being used, and what will happen is it is allowing more people to qualify. And also too, what the mortgage industry has been doing is, when, the example I use is like, say, if, hey, when Windows first came out, it was Windows 1, and then 2, 3, as they got more advanced versions. Now I think it's up to Windows 10, 11, something like that. It's the same way with the FICO scoring system. It's up at, started at 1, 2, 3. It's all the way up to like FICO 9 or 9.5. The mortgage industry right now is using like FICO 4 or 4.5, and they're doing that because it's much more conservative. So with the advent of the Vantage score, you're going to see, I think people's scores are going to be higher. At least that's what the indication is going to be. So they're saying that over the next couple of years, several years, that 1 trillion more in mortgages are going to be able to be written because of the change from the FICO scoring system to the Vantage scoring system. So what that is going to do, and they say that's equivalent to about 5 million more people are going to be able to qualify for loans. So that's going to put a lot more people into the market in the coming years. So you might see this as early as 2026, January, February, March. You might see not only with people anticipating that interest rates might drop down, but if they do, you're going to see more people coming into the market, but maybe more people having credit challenges. And because of that, the Vantage system that's going to be moving into that industry, the mortgage industry, you're going to see a lot more borrowers out there. So just be aware of that, and then the market has been over the last couple of years very tough. So they're indicating that the number of not only mortgage bankers, but the number of real estate agents is going to drop down as they need to get licensed for the coming year. So you're going to see a lot less people in the industry. But with these changes, you're going to see a lot more borrowers coming out to looking to buy houses. So delinquencies on debt they're saying it's the highest level that it's ever been. And people are basically drowning from debt, and because of that, they're having trouble qualifying for a mortgage. Where we're seeing the most debt is on credit cards. People are living on their credit, and because of that, even if they're making their payments on time, if they have high balances compared to their available credit, it is hurting their credit scores, dropping the credit scores down. And it can drop the credit scores depending on how high they go to the available credit as they get up to like 80, 90%. And sometimes we see it where people are over their limits, then it can drop their credit scores dramatically. I've seen it drop 60, 70, 80 points. So just by adjusting that or moving their credit profile around, maybe getting a little bit higher available credit, can drop their scores down, drop their scores way up, drop the available credit, that percentage down, and move the credit scores up, which would make them qualify not only for a mortgage, but maybe more programs going to be available for them. So before we get into the other industries, I just wanted to show you very quickly the impact of the credit scores can have on a person getting a mortgage. So if you look at this, this is just showing you that assuming a person's, they're looking at a mortgage, we could say 300 or 400, 500, 600,000 mortgage, but assuming that it's like say 0 points. So somebody at 740 and above is going to be looking at 6 3/4. And you can see that as the credit scores drop 620 to 639, and we call those buckets, that category from the 620 to 639, you can see it goes up 1/8% just with say the 0 points. So no additional cost to it. So at 700, 719, you're now up 1/4%, and then 680 to 699, and that jumped another 1/4%. So 0.5%. And the reason is because certain categories or buckets they see have a bigger or more dramatic impact on the people's ability or their future ability to make payments. 660 to 679, you can see it's up to 7.5, 640, 659, 7 3/4, and then 620 and 639, it's up to 8%. Now, it's important to remember that this is, again, just a snapshot in time. It may change. I mean, you may see a situation that somebody at 740 above at 6 3/4, and then instead of going all the way to 8%, they may be able to get at 0 points, like say 7.5, because it's changing all the time. Because mortgage-backed securities are bought and sold on the secondary market. It's almost like stocks now. You're seeing the market change. It's not as every minute that you're seeing a change, but there are, depending on what's happening in the market, you can see changes on, 2 or 3 times a day if the market's very volatile. But certainly, what we're trying to do with this slide is just so you get a clear picture that as the credit scores go down, the interest rate or what they're going to be offered, and this is true in any industry, is going to cost them more on that. So it's important, like I said, to realize that. And so this next one is,
I
if you were just looking,
have one question. So are you saying that the buckets could change?
no, what would change is like say the rate.
Yeah.
Okay, so you might like say if somebody had 740 and say if the rate was 6 3/4, if they were down to like say 620 to 639, they may be offered like say 7.5 instead of like say in this case it shows 8%. And the mortgage industry, when there was a lot of business out there, most of the programs stopped at 620. And you say, well, why six?
Heard that 620 floor was now 640. Did I mishear that? That's just an individual lender's decision.
Say that again, Sherry.
I heard that 620 floor was now 640. Some lenders stop at 640, or?
I think that's probably, well, it depends on the program, but that depends. I'd say generally speaking, on your standard conventional loan programs, you're looking at 620. That's Fannie and Freddie will stop there. And the reason why they set that limit, and it's been the 620 for a long time, is because if you look at the delinquency rate, once it goes below 620, the delinquency rate goes through the roof. And so they just said, okay, you know what? We're not going to do anything below the 620. Now, on your government programs like your FHA and other programs, they will go below the 620. I've seen we'll do, I think, all the way to 580. And certain circumstances, maybe a little bit less. But as this credit score goes down, like say below that 620, like say if it was 600 or 590, the interest rate is going to increase considerably more, and there's going to be a lot more hoops to go through in order to be able to qualify for that loan. So they're just not going to let anybody do it. They're taking a look at it now, and the reason is because there's a lot less business out there, and they've gotten a lot more flexible on what they're looking at because, and then what I think you're going to see as time goes on and say the market increases, like inventory is not an issue and there's a lot of loans going through the pipeline, a lot of houses being sold, you're going to see that restriction as far as that 620, you might lose that, say 580, might go to 600, maybe to 620 again. So the flexibility, you'll lose that flexibility. You're getting that flexibility now just because the market is so slow. And then this slide, what this does is trying to give you an idea, same scenario, but what they're doing here is keeping the interest rate the same. So this is telling you what the cost would be as the credit scores go down, what the cost would be in, like say the previous scenario at 6 3/4. So at 740 above, it's like say 0 points. So this would be like say discount points. So 720 to 739, you can see, it's $1,250 to get that same interest rate, the 6 3/4. And you can see 700 to 719, 2,500, 680 to 699, 3,750. And you see, as it goes down, it increases dramatic. So 660 to 679, 6,250. 640 to 659, 7,500, and then 620 to 639, 10,000. Again, remember, this is just like say when they did it, a snapshot in time. So it's not like say hard and fast. The thing to remember is as the credit scores drop, it's going to be much more expensive depending on how low the credit score goes, and that'll change. The actual cost will change from lender to lender, but there's still going to be a different cost. So if you had somebody that said had a a 750 credit score, and then you were comparing somebody with, like, say, a 650 credit score, I can guarantee it's going to be considerably more expensive. Now, the difference would be if you were looking at, like, say, a government loan program, like an FHA or a VA. There's still going to be a difference, but it's not going to be as dramatic because they're backed or guaranteed by the federal government. So a little bit more flexibility in there. So you may not be paying, let's say, $10,000 if you had a 620 credit score, but there's definitely going to be an additional cost to get that rate at the 6 3/4 on that. So that's the key to remember, because if you think about it, this difference in cost, if you look at it, let's just say if we go from 660 to 679, well, say if we have somebody that has a credit score that's, like, say, 677, and we can get them up into the 680 by just, looking at their credit report and maybe making some adjustments, we can get those scores up, and then that's going to get them into a better situation, get a better interest rate, and cost them less to get into the property on that. And then this last slide on the mortgage side of it, before we get into other industries, this is showing you the PMI costs, private mortgage insurance, which is basically insurance that protects the lender against foreclosure. And as the person puts more money down, the insurance becomes less, and the insurance companies go at 760 and above. But you can see the difference in the monthly cost. Now, this is with 3% down, so it's probably one of the more expensive insurances because there's only 3%. They're protecting the lender down to that 20%, because at 20%, there's no PMI. So at that 3%, you can see the cost 760 above is 237, and it goes all the way down, like 660, 679. You're talking about $630 on a monthly basis just for the PMI. And at 620 to 639, 950. Again, these are insurance companies. So there's only like 5 or 6 major ones across the country, and they're always competing. They're always adjusting their rates. So recently, one of the changes I've seen is if there's 2 people on a loan, sometimes the cost for the PMI is actually cheaper, because they're looking at it from the perspective, even if the second person's not working, they're looking at it from the perspective that, hey, if something happens to one person, you still have another person that is on the loan that can possibly, go out and get a job and help make the payments, and then not be in a situation where they don't end up going to foreclosure. So they give them a little bit better interest rate. But
Yeah,
again, go ahead, Sherry.
I was just going to say, I can understand the bank's point of view, but that sounds like discrimination to me, like single women would be discriminated against, as they have been by credit companies in the past. So,
Well, and
not one at the moment, but have been.
Well, it's actually, they probably get around it by, they're not focusing on the individual as far as male or female, or even in race. They're just saying that the percentages that if you have 2 people or maybe even 3 people on the loan, that there's the possibility of, put it this way, I guess they calculate that there's less risk for them on that. So, but I have noticed that there's a little bit of difference if it's just one person, and again, it doesn't matter male or female, as opposed to maybe 2 people on it. That's a question that we've been seeing. So it looks like they're getting a little bit better rate. But again, the idea is you can see that a person with lower credit scores is going to be much more costly and much more expensive, and harder for them to qualify for a loan, just because the cost is going to be higher, the interest rate's going to be higher. So they're going to qualify. Even the person with the same income is going to qualify for a lot less than that. So now this is some of the other areas that we're going to delve into to see where credit scores are going to have an effect. Now, and this one is looking at your homeowner's insurance. So whenever you get a loan or you own a home, usually you're going to have some type of homeowners, or they call it hazard insurance on that. Now, the insurance, different industries like the insurance industry, homeowners insurance, different industries like cars when they're doing car loans, they all have their tweaks as far as the credit scores are concerned. So the insurance score on a homeowner's insurance, it's based on a number of different factors, but they're looking at your payment history, they're looking at your debt levels and your credit mix. So what they're doing is they're seeing is, and they're also, let's see, the impact on premiums, higher scores, lower premiums, lower scores, higher premiums, obviously, other factors, state restrictions. So some of the state industries, insurance commissions have restrictions on what they can and cannot charge. But one of the other things that they're looking at, and the insurance industry, I know they keep these databases, but they're looking at your claims history also. That has a big impact. And some insurance companies will deny people insurance based on their claim history, the type of claim history. Now, the one thing I've noticed, and this is just from my own personal experience, that if you have insurance and say you have a leak in your basement and you're not sure whether you should claim insurance or not, you call up the insurance company and they send somebody out to take a look at it, and you say, well, it's not really worth it, I'll just get it fixed on my own. Just because you called them and told them that this happened, it's listed, most insurance companies going to list that as a claim. And I found that out the hard way. That's exactly what happened to me. I ended up taking care of it myself because it probably wasn't going to meet the deductible, very little over the deductible. And about a year and a half later, I was talking to an insurance person, and they pulled up my profile that they had, and this was a different company. And they said, oh, you had a claim, about a year and a half ago. And I was like, oh, I haven't. And then I got into it and I found out why. So even just calling the insurance companies could be a claim. So these are some of the things that are going to affect a person when they're getting their insurance. Other things that they look at when they say other factors, obviously they're looking at the house, the type of house it is, the location of the house, different things like that are going to have an impact as far as the homeowner's insurance and what a person's going to pay for that. So car loans is another area that they're going to look at. Now, generally speaking, what happens is when a person goes in to get a car and they're going to get a loan, the dealer's going to offer them a loan. They go to the finance guy, person types in their information. And what they do is they shoot that out to, it could be 8, 10 different banks to see what's going to be offered for that. So the credit score, just like in the mortgage industry, it's going to affect the interest rate. It'll obviously affect the loan approval and the terms that somebody's going to get and the amount of down payment they're going to require. I've seen car loans, believe it or not, I've seen people with the lower credit scores that say, I just got to have a car at an interest rate of like 18%. So if you think about, somebody's getting a $25,000 loan at 18%, it's crazy as far as how much is going to interest.
Yeah, I deal with renters a lot. And I used to think, oh, well, they just got a car loan. Their credit can't be that bad. Well, they just got a car loan because they're paying $1,000 a month for 7 years, because they have 18% credit.
Right.
And
go ahead.
Yeah, 18% interest and their credit's horrible. So they're not going to get, I'm not going to be able to help them rent anything.
Right. And what happens, what I've seen, and this is common, where somebody will, get a car, and I've seen it happen, like say when they're buying a used car. So they end up with a used car, and they end up with a maybe the car breaks down or something like that. And when they go into the dealer talks them into trading that car in and getting another car. And then they've got that loan for the new car, and the trade-in doesn't cover the old loan. So what they're doing is adding a loan on top of a loan. And then depending on their credit, well, it may be the same interest rate, a high one, or could go a little bit higher or possibly a little lower. But the person then comes out. I just saw this happen like 2 months ago. A person comes out where they're actually underwater for the car loan because they've added that on top. And, the bank, from the bank's perspective, if you're getting a loan on anything, house, car, and it's over 100% of the value, it's more risky for them. So they're going to charge you more. So, and then your insurance rates are probably going to go up too.
Yeah.
But
I had a question on that. So we know now that how much loan officers or brokers make is more regulated by the government.
Right.
I don't know if that's true with car loans.
It's not.
That's what I thought.
Yeah. And that's,
They think they can get more out of you. They're just going to get more out of you.
oh, absolutely. I mean, me being in the mortgage industry, I remember the last time I went in for a car and, you know, the person, but I would always tell people, if you're going in to buy a car, check with, if you're a member of a credit union, check with your credit union or your bank first. Then when you go in there, because they basically say, if you checked with your credit union says, hey, we can give you, 6.5%. And you go to the car dealer and they say, oh, we're going to offer you 9%. Well, that spread there, they get paid a premium for delivering a loan with a higher interest rate. And like you said, there's no restrictions on car loans like there is on mortgages. Mortgages right now are severely, I won't say severely, they're very, very regulated on how that works. Whereas the car industry, they kind of got a free pass on that. So yeah, if you ever go to buy a car, be careful with that, because they will try to give you something higher.
Don't walk in and tell them you're not going to use their financing, because they count on you using their financing when they price the car.
Right.
To you.
Right.
So you want to whip out
Exactly.
that credit union thing at the end of the negotiation.
Right. Right. Yeah. Or you can even and I've done this before, because I knew that I was going to be getting a better rate at the credit union. And so what happens is, if the car dealer, say if they provide you with a loan, and then that loan, it goes through the bank pays them a fee for that loan. But if that loan pays off, it's usually within like 2 or 3 months, the car dealer has to pay that fee back. And so what I've done is, in the past, working that into the deal, I just let them know. I say, hey, I know that if I pay this off, you're going to lose that extra credit. So, I asked him how long it takes. And, I think I was talking to one owner and he says, well, 3 months. If it's on the books for 3 months, then we don't have to pay a penalty for it. And so what I did is I got my credit union loan and I didn't pay the car. What I did is just waited that 3 months so I could work that additional cost into it, because if they know, they're going to try to wiggle out, like you said, because they're not getting that additional premium they might get on that. Very good, Sherry. You have some experience with that, huh? So,
well,
anyway,
we just
go ahead.
recently paid off some credit cards, and not only did the credit scores shoot up, but they're all offering us more credit, which would just make the credit scores go higher, which is crazy. And my husband's is above 850, which I didn't understand how that could be, but I know it's Citibank or something that's given him the credit score.
Right. Yeah, because when you paid off the credit cards, what that did is that dramatically lowered that ratio. And when the ratio is really low, their whole idea is, hey, we want them to charge more so we can get more interest. And believe it or not, I've seen some credit cards that are charging, it used to be that nobody went over 30%. It was like 29.9%. For years it was that way. Well, recently, what I've started seeing is interest rates that are in the 30s. The highest I've seen is like 39%, which, when you think about it, that's like loan shark rates. 10, 15 years ago, went to a loan shark, and that's the rates they were charging you. So eventually, maybe the government will step in and say, hey, you have to limit the amount, and they're going to cry and scream and say, it's going to hurt the business. But I mean, having interest rates that high is just to me, it's kind of crazy. But anyway, so car insurance. So this is another one. They insurance score for the car. So like I said, each industry tweaks their scoring system a little bit different, but they still use it because it is amazingly, it's an accurate predictor of how a person is going to be making their payments in the future. So on the insurance, they're looking at, it's impacted the premiums, but based on factors in the credit report, how likely they're going to file a claim. So other factors are looking at, obviously, the driving history, the claim history, the age of the driver, the location, and then also state regulations. A lot of states have minimums that they'll require a person to get. And if you want to get into car insurance, we can talk later. I can go into a lot of detail on minimum coverages of car insurance and uninsured motorists, because you can really get burnt on that if you're not aware of what's happening with that. But anyway, and through personal experience. So anyway, so the insurance, they're looking obviously at the claim history, but also the age of the driver. Ages of the driver, I know with the children I have had, that as their ages go up, the premiums go dramatically down. The younger the driver, and also, Sherry, they charge more for males than they do females. On the premium, so.
Doesn't make me feel better, but okay.
Okay. Anyway, so areas of our lives that are impacted by credit scores. So other areas, so loans and credit. So mortgage loans, home loans, auto loans, personal loans, student loans, credit cards, and lines of credit. So the lines of credit that you could throw in there what they call HELOCs, home equity lines of credit. And what they're doing with that is based on the LTV. In other words, the percentage of the loan with the first and second added together to the value of the house. And then also your credit score will determine on the interest rate that you'll get. And usually it's tied to the prime rate, might be prime +1, or it might be prime -0.5. It just depends on what the bank is charging. The thing to be careful about home equity lines is usually the limits or the maximum they can go is up to 18%. And so people are saying, hey, I'm paying off these credit cards are like 25, 30%. I'm getting them all down, maybe getting down into like 10% or 8.5%. But if things start to change, then just remember that that can go up pretty dramatic. So people have to be aware of that. And then talking about the lines of credit and the home equity lines, I've seen another program out there, and I haven't seen it through mortgage lenders, but I've seen it through like advertisements on TVs and different areas. But they're basically offering people credit, but they're not, and they're saying, hey, there's no credit, it doesn't matter what your credit looks like. We're not qualifying you. We're just, working it. What they're actually doing is, once I dug into it, is they're actually taking a stake in the equity in the property. Now, most of them are based on the future equity of the property. So if you, and depending on the program will determine how much equity, I'm sure, or the percentage of equity that they're looking for. And the ones that I've looked into is the future equity. I'm sure there's going to be some coming out that will be based on the past equity too. But what they're doing is, say if a person has $500,000, house, and they want, the first trust is lower, but they want to get a second trust or this type of loan program, and they want to, I'm sure it will be recorded against the house, but they can't qualify for the credit and everything. So they would do this type of with equity share. So depending on the percentage that the company is getting, as time goes on, then what's going to happen is, say if it goes from 500 to 600 to 700,000, if they have, say, 20% of that, then when the house is sold or refinanced, they're getting that percentage back. So that's how they're getting it. And there's also a certain amount of fees that are charged up front. So if you have somebody that's looking at that, I've already had a couple of people approach me with that. That's why I dug into it a little bit. It can be pretty ominous as far as the cost that would be to the consumer. And a lot of times borrowers are just not aware of how they're getting clipped on it. So other areas that you're looking at that impact the credit scores. So auto insurance, homeowners insurance, renters insurance, and business insurance. So everybody, Sherry, like when you deal with renters and they go to rent a house, they're supposed to be getting renters insurance. And if their credit scores are low or their claim history is, then there's a chance that they may not get insurance, but also too, it's going to cost them a considerable amount more than somebody that has, like say, a good credit rating, very low claim history on that. So other areas, housing and rental. So the rental application for housing, rental application for equipment, and security deposits. So I know that depending on, I know for a house, they're restricted on how much they can charge you as far as the security deposit. But in other areas, if they're more concerned about the person and the credit, they're going to charge more in the security deposit on that. So other areas, so electricity, gas, your utilities, basically water, internet, cable. And then I know with the utilities, some of the utilities that if they don't have a history with you, or they see that your credit is not what they consider to be, up to par, then they charge you a fee. They want you to put a deposit down, basically, kind of like a security deposit. And then as time goes on, if you're making your payments, they'll refund that back to you or apply it to a bill. But to start out with, you could get charged that up front. So more cost for people whose credit is not, not, put it this way, they're having credit challenges or credit issues on that. And another area that you're looking at is considerable is employment. So employment, professional licenses. I know that in the like mortgage industry, I don't know if it's crept into the real estate industry. Maybe you guys might be able to tell me, but I know in a mortgage license, they run our credit report. And if you have challenges or issues with your credit, you can be denied a license. And I've actually seen that happen where they denied a person a license just because they didn't like his credit. They felt that his credit in the past wasn't sufficient enough to be able to grant a mortgage license on that. Believe it or not, believe it or not, banks and credit unions are not required to have their people licensed. So they say they're covered under the FDIC, the national, and so everybody that works for them is automatically licensed. So the state of Virginia told this individual, said, hey, go work for a bank or a credit union for a couple of years, get your credit straightened out, and then come back to us and we'll approve the license, which is kind of crazy, but it can affect you. I don't know. I'll just throw it out there. If anybody is aware, when you guys are getting your real estate license or reapplying for the license, are they looking at your credit at all?
In Maryland, it's only if you're getting a broker's license.
Okay.
Otherwise, they
as
don't
far-
look.
Otherwise, they don't bother you? Okay.
Yeah,
Because
but
I heard that several years ago that it's trying to be introduced, but I just didn't know if it went anywhere.
Well, that's just Maryland, so I don't know about
Okay.
Virginia or DC. Gosh, I forgot it.
Okay.
Oh, and I read about the loan licensing. You guys have to get fingerprinted. That
Yeah,
shocked me
they
because we
they
don't.
not only fingerprinted, but they do an FBI background check too. So yeah, and this is when you first get your license, you have to do that, and then I think it's like 3 years, you have to go through that again. And each state, like say a mortgage person, like the company I work for, each state that you're licensed in, you have to go through their continuing education, you have to go through their requirements. Whereas, like say, if a person works for a bank or a credit union, they're automatically approved. So if you have somebody that's getting their loan through a bank or a credit union, you just have to be real careful because the people that they're dealing with may not, they could be somebody that they just hired and they have no experience on that because there's no requirements for them to be licensed on that. It's just like, if you think about it, if somebody doesn't have a real estate license, they're just going out and selling real estate. So it can get pretty ugly pretty quickly. The third one there is this is really, really a kind of a big deal, especially in our area where you have a lot of people working either for the government or working for a contractor that has contracts with the government. I know that my brother, he had a lot of security clearances and working for a contractor, and the contractor was only able to get the contracts with the government because they had certain people with certain security clearances. And they do a review depending on how high your clearances are. They'll do a review on your one of the areas that they look at is your credit every year to see if your credit is good, if you're having issues making the payments, because somebody with challenges with their credit is going to be more susceptible to doing things that maybe they shouldn't be doing, and it could lose their security clearances. And in this area, like I said, it can make a huge difference on the amount of pay that a person gets. So the higher the security clearances, they can get paid considerably more than somebody with little or no security clearances. So I know that dealing with people that have had security clearances, they're very, very protective of their, they have to be protective in a lot of areas, but one of the areas that they're very protective of is their credit and their credit profile. So now, how can you improve your credit score? So pay the bills on time, and these are pretty standard, but we can dig into each individual one if you'd like to, if you have any questions. But lower your credit utilization. That was like you, Sherry, paying off the credit card or getting their balances down as low as possible with that percentage. Keep your old accounts open. I always tell people, don't close your accounts unless you just have a gazillion of them and say, I got to get rid of some. But what I tell people to do, so you can keep the availability of the overall credit amount limits higher, is what you want to do is maybe every 3 or 4 or 5 months, just take out one of the cards and put a tank of gas on it and just kind of rotate them that way from the main ones that you use. The reason is because when we pull a mortgage credit report, there's also a section in there that says the last time it was used. And so that takes into play, or that has an impact of your credit scores also, because you have a lot of accounts out there and they haven't been used for years, then those are going to have less impact than one that you've been using on a continuing basis or been using it, like say every 4 or 5 months. And I notice too that some of the older accounts, if you haven't used them, what happens is they actually, well, you'll get a notice that they'll say, hey, if you don't use it in the next couple of months, we're going to close the account. So number 4, limit new credit applications. So just don't go out and start applying unless you're trying to do transfers. Then you can do that. But just remember, if you do that for the short period of time, it's going to have an impact on your credit scores. If you're only doing like 2 or 3, it's not going to have a huge impact. But if you're doing a lot, it's going to, the more you do, the more of an impact it's going to have on your credit scores. Diversify your credit mix. So different types. If you have any credit at all, like say, if you can pay it all down and just have the mortgages or just have everything paid off, that's going to put you in better shape. But you want to have credit availability, because if you don't, that's going to hurt your scores too. I've had people that paid everything in cash and they weren't able to get a loan. And this was several years ago. They're changing that now, where we can develop other types of credit based on, like say, utilities and other things that they pay. But it makes it tougher for a person if they don't have credit scores, or if they're paying everything in cash, don't have credit. And then dispute errors on your credit report. This is important because errors will come up, and I'll send you, or actually one of the slides, and I'll be sending you these slides out. But on the next slide, we'll show you a credit report area that you can get a copy of your credit report, and you can dispute errors right there online. So that's important. So just don't let those things go on if you see there's an error on it. And avoid collections and charge-offs. So if you are going to get something, you want to make sure that you address it and just not let it go, because it'll eventually show up on your credit report and can ding your credit scores on that. And they're saying like number 1 and 2 are probably the most important on that. And then this website is the website that you can go to. It's the government required the 3 repositories to open up this website. It's been there for a number of years. You can go there and you can get one free report every 12 months from each repository. Now, what you could do is, like say, go there and get from Equifax, wait 4 months, get it from Experian, wait 4 months, get it from TransUnion, and then wait till you go back to Equifax. It's been that 12 months, and you can continually rotate and see, especially now because all the creditors are reporting, generally speaking, to all 3 repositories. But from time to time, you'll go into this report and they'll waive that thing. They say, hey, we'll allow you to get a credit report, once a month. Especially when I saw it with the pandemic, they were allowing people to pull credit reports every couple of weeks without any charge. Now, when you do this, they'll try to sell you other things like credit protection. You pay an extra fee, you can get your credit scores, but really just need to monitor the credit report to make sure everything is running smoothly for that. And let's see, wow, what happened there? And I think that was actually the end of it. let me go real quickly to that. And it went back. Anyway, so the last one is questions. Does anybody have any questions on that? We good?
I think they did a great job of asking him along the way. So
Yeah,
So
absolutely.
I
Well,
sent you the roster so you can get the slides, the slide deck out to them. And thanks guys
Okay.
for attending.
absolutely. So if you guys have any questions or anything, need any help with anything, just feel free to give me a call.
Yeah, all
Thanks,
the
Steve.
information's
Bye-bye.
on the slide deck. So that's why we
Exactly.
send it out to you. Yeah.
Thank
All right,
you.
Sounds
guys.
good. Okay.
Thanks. Have a great day.
Bye-bye.